All right, so in this video, we're going to talk about understanding credit spreads, which is higher probability trading strategy. So why trade spreads? Well, the problem with buying options is that theta works against you. Remember, every time you buy an option, every day that passes, that option is going to decay as it gets closer to expiration. So time is always working against you. And not only do you need to be right in terms of direction with your move, whether it's up or down, but you also need to be right in terms of how fast it moves, which adding a whole another variable like that makes trading a lot harder. And typically win rates are just a lot lower because generally options are very hard to make money from if you're simply buying them. And so the solution is selling spreads. And essentially what you're doing is shorting options instead of buying them. And by doing with spreads, data works for you. So if the price does nothing, you can a lot of times make money for even if you're wrong on direction. The stock can go up, sideways, or slightly down. You can position it however you want to make money. There's always defined risk with spreads. You know exactly how much you can lose on every single trade and exactly how much you can make on every single trade before you put the trade on. So let's give you a real example of a bull put spread on SPY. So again, let's say we have SPY and it's at $500. And with a spread, you're buying an option and you're also selling another option at a different strike price at the same time. So let's say SPY is at $500 and we decide to sell the put option at $490 and we decide to buy the put option right below it at $485, right? So we're selling this put option for $2. We're buying this put option for 50 cents, which means we're going to get a net credit of $1.50. So at this point, we're not even buying an option. We're actually getting a net credit, okay? And again, it's times 100, so this is $150 of a credit that we're essentially getting from the broker, right? So we're collecting $150. So how would this actually work out and how would this make us money? Well, we're selling the out of the money strike at 95, right? We're buying the further strike at 90 in this example here. And so the goal is you want the stock to stay above your short strike, okay? And if it does, both options expire worthless and you keep the full credit. So all you have to do to think about where I want this strategy to happen is all you're betting on is that the price is going to stay above $95. And as long as price stays above $95, you're going to profit. You're guaranteed to profit. So for example, if we're shorting the 95 strike price right here, and then we're buying the 90 strike price right here, we're going to get a max credit of $150. And if we take the width of the spreads, so remember 90, and we subtract that from 95, we're going to get $5. And if we multiply it by 100, that's $500. If we subtract that from the 150 credit we received, that's going to be our max loss, which is $350. And for ordering us to actually have this max loss occur, price needs to be less than $90 at expiration, right? And as long as price stays above $95, we're going to be in the profit, okay? And really at expiration, as long as we're above 95, we're going to collect that full $150. And if price goes lower than 90, we're going to lose $350. And you may be saying, well, this doesn't really make sense, right? If I do this trade every time I lose, I'm going to lose a lot more than what I'm going to make. But with these types of trades, what you're betting on is probability because the price may be at $100, you can see, while you're putting on this trade. So the stock price can go up and you're going to make money. It can stay flat at $100 and you're going to make money. It could even go down a few points and you're still going to make money, right? You're betting on the idea that this stock is not going to go down more than 5% or down to 95, and that's why you make money. It's very high probability trades. The same thing could be done on the bear call side, right? So let's say you're going to sell the calls. So you're selling the 105 strike and you're buying the further out of the money 110 strike, okay? And so you're going to get the same thing. You're going to get a max credit of $150. Max loss can be $350. And now you're betting that price is going to move lower. So let's say the current stock price is at $100, right? And you're selling the 105s and you're buying the 110s. As long as price stays below 105, you're going to make that $150. If it starts to get above that, that's where you can end up losing money. So a bear call spread is a neutral to bearish strategy because, again, as long as this price stays flat, it could do nothing until expiration, you're still going to make money. Or if it dumps even lower, you're also going to make more money. So the math is very simple, right? The risk rewards and calculating your kind of boundaries here. So let's say again, in this example, our spread width is $5, right? So let's say we sell the 110 strike and we buy the 105 strike. The difference between those is $5, right? Now, all you have to do is take that and subtract it from the credit that you receive, which would be $150, and that's how you get your max loss. And again, you may be saying, well, why would I risk $350 to only make $150? Well, you're getting a much higher probability of winning. And you can also calculate what your probability is. You can take 70% trades, 80% trades, 90% trades. There's a million different ways that you can calculate and set up the probabilities to be in your favor. So calculating and knowing this risk reward is really important because it's going to make sure that you know exactly what type of trades you're going to be taking. So when should you be trading credit spreads? Well, typically it's best when you trade them in high implied volatility environments because the premiums tend to go up a lot more. So you tend to get paid more. Now, it's very common in the trading world that 30 to 45 days expiration is what we call like the Goldilocks zone of when to actually trade these, because that's when theta decay or the theta decay curve starts to accelerate very quickly. However, it's also very advantageous to trade these on a 0 DTE expiration. So it's trading 0 DTEs, 1 DTEs very quickly because that's when they actually accelerate the most and they tend to decay very quickly. You can also do these when you have a clear support resistance at these technical levels, okay? And again, the advantage here is that you're trading with the advantage of time. So as long as the market does nothing, you can still make money. If it stays flat, you can make money. If you're buying money, if you're buying the calls, you could actually lose money, right? Because you're playing against time. So that's why credit spreads are really advantageous because you can make a lot of money essentially trading them, even if you're wrong about direction, as long as you're right on time and you get the right strikes. So that's the end of this video. I hope you guys did enjoy, and I'll see you all in the next one.